It's time to talk about tax. Okay, so I know tax is so boring, but it's about to become sexy. So in this video, I'm going to be breaking down everything you need to know about what taxes you're going to pay on your buy-to-let property investments. Now, tax is actually a really important part of business, that the more and more you learn about it, the more interested you get, because let's face it, the money's going to be better in your pocket than the tax man. So let's look at how much we can keep in yours rather than giving away. Let's jump straight in. So first thing I want to say is people focus way too much on the gross. And what I mean by gross is people talk about, it's just vanity metrics. You may have heard of, what is it? Turnover is vanity, cash is sanity, cash flow is king. Probably butchered that, but it's true. Everyone gets obsessed with, I've turned over this amount, or yeah, I get this from my rent, and it's just like, well, actually, you do need to take account of your tax within that. So let's break it down. Before we jump in, I think it's really important to say I am not a tax advisor. I'm not qualified to give any tax advice. This is just one man's opinion. So if you take it on your head, okay? But seriously, I'm not a tax advisor, so please don't take anything on this as advice. So taxing property has become more and more important since around 2017 because everything kind of changed. So you'd get a furnished property, and when I go furnished, I mean people would buy a £200 furniture pack and chuck it in the loft because you'd get wear and tear allowance on that. And it just made so much sense where you could basically not pay tax for a long time on your profits, because actually the reality versus what you tell the tax man is very different. And that sounds dodgy, but it's really not. It's the way that accounts are done. So as I said, everything changed in 2017 when something called Section 24 came up. And what this meant is that over time, what was meant as profit, because you only pay tax on your profit, completely changed. So what is Section 24? Well, the key thing with Section 24, and it's phased in over time, so 2021 is the first year that the allowance is completely eradicated, and this is based on the interest from your mortgage. Okay, so what used to happen is the interest that you paid on your mortgage was counted as a legitimate cost of business. And so let's say, for example, you made £500, but your mortgage interest was £200. You would only have £300 minus whatever other costs. But then the government decided, actually, interest, i.e. the loan that you're getting to build your portfolio, we're not going to count that as a legitimate expense anymore. Thank you, government. So what happens over time is there's no allowance. Now, if you are in a situation where you're in that lower income tax bracket, i.e. 20%, it doesn't really affect you. However, if you are above that, a higher income tax earner at 40%, this is going to be really important to you. So the reason that's important is instead of it counting as a legitimate business expense, which it's not anymore if you own a property in your personal name, you now get a tax relief. And that tax relief is up to 20% of that profit. Okay, sorry, 20% tax on that profit. i.e. if you pay 20% tax on it, it still is pretty much flush, you don't pay any tax. Whereas the next 20%, i.e. for higher income tax earners earning 40%, you are going to get massively penalized. Now this might seem like a really small thing, but this had a dramatic impact on the buy-to-let investment community where everyone got the tax advice to own the properties in their personal name. They'd worked and retired all their life based on this portfolio. So I know people that post-tax were taking home 60 grand a year. Okay, and then suddenly a majority, and I do mean over 50% of that profit was wiped out because it was no longer a legitimate expense. So they had to transfer it all over to a limited company, which is what I'm going to go through now. So again, this isn't tax advice, but I'm going to tell you what I do because I'm on that threshold. I make sure that I don't go into that 40% because obviously I control what I get paid by my businesses. But I make sure I don't go over that threshold by owning properties in different limited companies. It doesn't matter that it's limited, it's just how I structure things. But owning it in a limited company, instead of paying income tax on that, you are going to pay something called corp tax or corporation tax. Now, currently, corporation tax is at 19% rather than the 40% that you'd be paying on your personal income tax. Now, as of the April budget of 2021, it is looking to scale from 19% to 25%, but that is going to be a scaled thing. So it's from 50 grand up to $250,000. Most of you won't be affected on that for a very long time. But a majority of the advice you get if you are in that higher income tax earnings, you would likely want to set up in a limited company just like I do. Again, not financial advice, just my opinion. But that's just one level. What about the allowable expenses that you can factor in, and you definitely should, to mitigate your profits and therefore your tax on your income? So, what's allowable? Okay, and allowable is a really important term because you might think of some things that are completely legitimate, but they can't actually be used. So, I've got the list written down that I could think of just so I don't miss any, but you might want to write these down. So first of all, any rates on the property. So for example, if you pay the water, the bills, any council tax, that is a legitimate and allowable expense. Now, on a buy-to-let property, that's usually only when there's a void, i.e. it's empty. You always have to pay some council tax and usually water rates on a property. You will have to pay them if it's empty. If it's tenanted, then the tenant normally in 90+% of the circumstances will pay for that. However, in a HMO, a house of multiple occupancy, typically you as the owner and the landlord of that property will pay for the bills. That is completely legitimate as a tax expense. You've also got any agent fees, any cost of services, for example, your gardener, if you've got a gardener on the property and things like that. You've got costs of renewing leases. So let's say you've got a tenant that ends up leaving, they need to find you, so tenant finding fees, that's completely tax deductible. Mileage, legitimate mileage, okay? And it depends how you do this. In a limited company, majority of the time you own the car or you lease a car in your personal name and then you claim mileage back, which is 45 pence a mile for the first 10,000 miles. Which takes account of the depreciation of the car. If you own the car in a limited company, there's other tax bits in there like benefit in kind. So I'm not going to go in that. I prefer to own it in my personal name or lease in my personal name and then claim back the mileage. Now, the key here is it has to be for sole purpose of that rental property. So if you drive there, you go do viewings, etc., that is legitimate. Okay, what about marketing? Well, actually, a lot of people miss this out. If you do your own marketing to build your property portfolio, all of that is an allowable deduction for your expenses. And a lot of people don't take account of that. What if you're putting up some posters to get tenants in, if you've got a HMO portfolio or things like that? Any additional marketing spend you're doing to get tenants into that property, again, is tax deductible. And the biggest one is allowable expenses on the refurbishment of your property. And there's very key terms around this, okay? So you can maintain the property, but you can't improve the property. Now, let me get that down. You can improve it, obviously, but if you're improving way beyond, i.e. adding value, I'll give you an example of this, that would count towards your capital gains tax if you ever sold the property and made a massive profit on that. However, if it's maintaining the property, then that counts towards your income tax, which most people don't know that, but it's really important. Let me give you an example. If you've got a sofa in your property that costs £400, let's just say that. If it was completely ruined and you bought another sofa to put in there that cost £400, that would count against your income tax. Okay, so you can see how people don't actually pay tax on property for many, many years to come. However, if I decided to upgrade or improve that, and so I put in a sofa bed that costs £550, I'd be able to claim back the £400 of that, not the £150. That would count towards capital gains. I know it can be confusing, and the honest thing is, where does the line get drawn there? It is a bit of a grey area, but talk to your accountant about it, not me. As I said, I'm not qualified. Another example of this is if you've got a £3,000 kitchen, and it's completely ruined and worn down, and you put in another £3,000 kitchen to get a new, new units, etc., completely fine and tax deductible against your income tax. However, if I decide actually I want to put in granite worktops and a £10,000 kitchen, a majority of that is improving the overall appeal of the property, not just maintaining it. And what that means is a majority of that money is going to go towards capital gains tax. The reason this is really important, because some of you might go, well, I'm saving the tax eventually anyway. Well, yeah, that depends on your exit of a buy-to-let. A majority of buy-to-let investors that I know, including myself, the exit is death. For me, okay, I do not intend to sell any of the properties ever. That's just my personal opinion. Will that change in the future? I don't know. Also, I believe in delayed tax, okay? So I'm never looking to avoid or not pay any tax, but if I can pay my tax in 15, 20, 30, 50 years rather than today, what that's going to allow me to do is enjoy the power of compounding with my investments a lot more aggressively rather than paying too much tax today. So I'm going to do everything I can, and my opinion is you should too. Try to get as much as possible sitting in front of that income tax bracket, or income tax as an allowable expense, rather than the capital gains. Okay, so everything you're doing relating to the ongoing maintenance and running of this property is fully tax deductible against your income expenditure. So just to wrap up on this, how do you actually work out your taxable profit? This is actually a very simple equation. So what you're going to do is you are going to work out your taxable income. Actually, just your income. So for example, your gross rent, etc., and you're going to total this up over a tax year. Now, typically a tax year is April the 5th. And that's when it starts, but it can also be when you set up your company. It's really down to you and your accountant to work out. You also need to decide with your accountant whether you're going to do cash or accruals accounting. Okay, and talk to your accountant about that. I'm not going to give any advice around that because it really does depend massively on your personal situation and how you want to do that. What we're then going to look at is your total allowable expenses. And then you are going to do this number minus this number, and that is going to be your taxable income. Now, this is where the figures differ so much. It's also why there's different types of accounting. So you have management accounts that is not for the tax man, it's for you and your internals, because what your profit is compared to your profit is actually different a lot of the time. i.e., I don't make a lot of money and I make a lot of money, okay? But it's really down about being strategic and making sure that you're not evading tax, okay? And that's why you need to talk to an accountant, because you can bend the rules and go into that sort of grey. But when I'm talking about that, I mean making sure you're focusing on maintaining the property rather than adding value or improving. Little bits like that, you want to talk to an accountant about this, because you want to be as much in that black and white and in the right side of that, rather than going into the stage of evading tax. Now, your income minus your total allowable expenses is going to give you your taxable income. Now, your target with this is to mitigate your tax liability as much as possible. What you'll find if you do this right is actually you won't have to pay any tax on your income for many years to come, because a lot of a refurbishment in a property can be against your income tax, not your capital gains. But it's really important to remember that you will end up paying a bit more on capital gains if you ever sell it down the line. So the last thing I want to talk about is loss carried forward. Now, this is going to change slightly based on the complexity of your portfolio and how many properties you have. So make sure you get individual tax advice. But a question I get is, what if I made a loss last year? Can I carry that forward? And almost definitely the answer is yes. I want to make a loss on my properties for as long as possible to mitigate and defer paying that tax. So the great thing about tax is it's not just, oh, I lost 10 grand last year, but I made 10 grand this year, therefore I made 10 grand profit and I get taxed on that. Actually, it's more like I made a loss of 10 grand last year, I made 10 grand profit this year, so I've made no money overall. So I don't pay any tax. And it's really important for you to embrace tax, because the difference is, and this is why you get a great accountant doing this, is on one hand, you can make a load of money in reality and pay a load of tax on that, or you can make money and defer your tax down the line. So I hope that's been valuable for you. I know that's a very different video to what I usually do, but tax is sexy, okay? And the more money you make, the more money you want to keep, the more that tax becomes important to you. Let's say you're at that highest income tax earning and you're getting 50% tax on your income. If you make another pound, which everyone else focuses on, you're only really making 50 pence. Okay, if you're getting taxed 50% on that. Whereas if you save a pound on your tax, you are making a pound. And so a majority of people, when you're making a certain amount of money, it's a lot easier to make money, legitimate money, through your tax savings rather than making a load more on this side. Something to think about as you're building your portfolio, and the earlier that you can be strategic against this from the foundations before you start, the better off you're going to be in the next 5 to 10 years. So talk to your accountant, get proper financial advice. Hopefully that's added value, and if you did get value, of course, make sure to hit the subscribe button and the notification bell, and it would help me immensely for the YouTube algorithm if you lightly smash the shit out of that like button and leave a comment below letting me know what you thought of this video. And if you've got another 10-15 minutes, give this one a watch as well.